Okay, first off, any questions about anything that we've looked at so far? Seems like my audio might not be. Proper. There we go. Okay. No questions about anything so far? So I had said we were going to do a little bit more work with holding companies. In fact, we're really going to do a fair bit more work with holding companies, but to at least get us started here, the next thing we want to look at is a scenario. I'm going to use a slightly simpler scenario than what you had presented, Bonnie, and it's going to look like so. So this time I have an operating company. Okay, and my OpCo has 2 shareholders. Okay, got Mike over here, and Mike is going to own 50% of the shares of OpCo, and then Janice over here, and Janice also owns 50% of the shares of OpCo. Okay, and let's say in a given year, OpCo generates, let's say $400,000 of net income that's not needed in OpCo. Okay, does that make sense? And we decide then that we're going to pay that to the 2 shareholders. So what we could do here, very simply, is if we don't have any other arrangements in place. Uh-oh, is anybody out there? Nothing at all in chat. Thanks, Stephen. All right. So what we could do here is just pay $200,000 of dividends to each of them. Okay, perfect. A great time for the lunch coma. So the problem here is that this may not match their tax planning. Okay, I like it, Todd. All right. So what we might do instead here, thanks, Betty. Yeah, good to have you back too. I didn't clue into who it was, Betty, there. So, okay. So and we had a weird thing happen with another class this morning where some of their students accidentally ended up with us, which was confusing for me as well. All right. So now this might not be ideal. So instead, what we can do here, and this is a fairly common arrangement, is we can have Mike and Janice own their shares of OpCo through their own respective holding companies. And instead of paying those dividends to Mike and Janice personally, we pay them to each holdco. And what might happen now is maybe Mike says, yeah, that's great. I'm happy to have that holdco, but I'm just going to take the full $200,000 out. I need that. I'm buying a vacation property in Florida this year, and I need as much cash as I can get. So Mike takes all $200,000 out. Okay, and Janice, maybe she does things differently here. And maybe she decides to leave $100,000 in holdco, and she takes a $100,000 dividend. Okay, and really what it allows then is for each of them to plan their affairs on their own without having to have any kind of input from the other. Okay. What you might even do, and Bonnie had mentioned this before the break, what you might even do here is maybe Janice, instead of owning all 100% of her holdco, maybe she does something like this. She owns 51% of her holdco, and maybe the other 49% is owned by Dennis, her spouse. Okay, or some other arrangement like that. That's fair. We could do a Class A, Class B, or anything like that. Now, I would caution that typically both the holdcos and the opco are going to be subject to the unanimous shareholder agreement. So you may not be able to bring Dennis on as a shareholder, because generally speaking, all these entities are subject to the same USA. Okay, that's usually what you're going to see. Okay, questions there? Okay, and now you see how complicated this can get, right? Yes, this is, I think, Todd, a fairly simple example, but I can really stack holdcos in here. We'll see later on. I could have a trust own shares. There's all kinds of stuff that can be done here. Yeah, exactly, Bonnie. So, so a couple things to show here is that, yeah, again, if we have, let's say, a CDA credit. So just for the sake of argument, let's say we have $150,000 of LRIP and $25,000 of GRIP and $25,000 of CDA credits, right? Same type of deal here. I could move those up each in half their proportions, okay? Good, so I would move, I'm doing that. Oh, sorry, I have those numbers wrong. Let me double those all. Sorry, that should be 300,000, 50,000, and 50,000. Okay, and now I could move up 150 of LRIP and 50,000 of GRIP, or sorry, 25,000 of GRIP and $25,000 of CDA. Okay, that's good. Okay, I see that. I got the Garfield thing, Stephen. Okay, so I could draw some whiskers in there. I'm not going to though. Now, the other comment here is that we actually don't have to pay. So legally, if we're following the Business Corporations Act, we're not required to pay the taxable accounts in the same proportion. So we must pay $200,000 to each shareholder. That's true. But we could break up the tax accounts differently. So at least legally, you could have something like this. You could do, let's say, $100,000 of LRIP, $50,000 of GRIP, and $50,000 of CDA to Mike or to Mike's holdco. Okay, and I could also do then just $200,000 of LRIP to Janice's holdco. That would be legally fine. Okay, and income tax wise and so forth, that would be fine. Now, do you think Janice would go for that deal? No. And once again, what would be the, why would she, Bonnie, right? What would be the rationale, or sorry, what would be the tool she would use to prevent that? Yeah, exactly, Melanie. That's likely going to be prevented by the USA. Perfect. Okay. Nice, Bonnie. Maybe that too, but the USA is the easier way to do it, the less violent way, Bonnie. Okay. Okay, that's all good. Now, as to why would she, there actually might be a valid reason for this. And you wouldn't see this if Janice and Mike are dealing at arm's length with each other. But if they're husband and wife, for example, it might be better for one of them to get more capital dividend or one of them to get more GRIP or whatever the case is. You see that? So with husband and wife, you might pay the same amount of dividends to each, but with different tax characteristics to achieve a specific tax outcome. Okay, I think Ksenia's got the phantom mute thing too now. All right. Now the GRIP one is better, Bonnie, right? Remember the GRIP dividends are going to be eligible. They're going to be taxed at about 30% of your normal tax rate, whereas they're going to be taxed at about 70% of your normal tax rate, whereas your LRIP dividends are non-eligible. They're going to have the bigger tax, right? Okay. Because it was taxed at the low rate, and now that means more tax has to be collected. It was taxed at the general rate, which means less tax now has to be collected. Okay, that's good. All right. That's fun, isn't it? Do we see how this starts to get, I don't know, I find this very interesting. I find when you get into this kind of thing, you can really start to get a handle on how people incorporate, why they incorporate, what the benefits are of incorporation. Okay. Oh, well, I guess it depends where your L and G go in that mental math, Bonnie. Yeah, okay. All right, now we're going to talk about a fairly difficult concept, actually. This is one that people run into a lot of struggles with. There is a specific, oh God, no, Stephen, no. In fact, so we'll talk about this a little more later on, Stephen, but one of the things that I always suggest for the financial planner, okay, is that the first time you sit down with a business owner client, okay, the very first time you sit down with a business owner client, you draw the structure with that person, okay? The fancy name for this is a cap table. We would often refer to this whole thing as a cap table. Let me just get rid of something here and I'll show you what I mean. Because you're not going to draw this stuff, right? No, I would say 100% of business owners, maybe 99% of business owners do not understand this. I find the only folks I sit down with who own businesses who understand this are people who have done a bunch of transactions with their businesses already. I can't get rid of that. There we go. That didn't work at all. All right, anyways, you draw this thing out. You with me here? And it will be the first time that that person has ever seen that. Okay. And they will find it helpful and useful. They'll say, yeah, that makes sense. That's my corporation. You did it. So yeah, we call this a capitalization table or a cap table. Okay. And I recommend the same on the exam, that if you have a question with Mike and Janice and Holdcos and Opco and so forth on your exam, you draw it out. And you're going to see this, that every question anybody asks me from this point on, I'm going to draw it out. Good? Because really what happened here, Stephen, is 7 years ago, your client sat down with their accountant and their accountant explained it once. Good. And then they signed a bunch of paperwork and now they feel stupid that they don't know what question to ask the accountant. Okay. Good. Okay. Those of you who deal with business owner clients, I think Melanie, you got some business owner clients. Todd, you got some business owner clients. They don't know their cap tables, do they? No. No, not on the financial statements, Shade. Okay. On the financial statements, they will not have them divided out into active and, well, okay, it's not exactly true. Normally what you'll see, I shouldn't say that. Don't worry about the tax rates, Shade. Your financial reporting is not going to reflect your tax rates. That's why you have a tax return as a separate document from your financial statements. Okay. But what you will see on there is that your active income is typically reported as revenues, whereas passive income is usually going to be reported as other income. Okay. Yeah, and that, so your EFPS, That's right, Todd, isn't it? Yeah, that's right. Your EFPS folks are going to do exactly this with their clients or with your clients. Okay. Yeah, it's a true story, Bonnie. That's one of the reasons I told you before that you might actually want to set up a holdco, right? So your passive assets are separate from your active assets. So 100%, the holdcos could sell opco here. That would be a perfectly valid thing. Okay, good. All right, so now let's switch gears here. We're going to look at professional corporations. And this has a lot of overlap, and I talked about this once already, a lot of overlap with our limited liability partnerships. Remember on Tuesday, whatever day it was, we talked about limited liability partnerships. So the idea here is we have certain professionals who have traditionally been barred from incorporation. Okay, and the idea here is that really legally we want, and whether you actually want this or not, I don't know, but we want patients and clients to have the right to sue people and not run into a corporation as protection. Okay, so the idea here is the physician who's a fiduciary, we want that physician to be really held to that fiduciary standard and not be able to insulate themselves from liability this way. That's good. But starting around 40 years ago, we started to see the ability for these folks to incorporate. However, and this might look familiar to some of you because it's actually not much different than what happens for financial advisors. So I've got my physician here, and they set up their Prof Corp. Okay, and what makes it a Prof Corp is that it's owned by a physician or by the relevant professional. Okay, whatever we're dealing with here. Okay, and it is registered with the provincial licensing body for physicians. Okay, so in Alberta, for example, you would have your Prof Corp licensed with the College of Physicians and Surgeons. Okay, and the College of Physicians and Surgeons sets out the rules for Prof Corp. So the college in this case says things like, and this is going to vary by province. So the college says who can own voting shares, and that's often the professional only. It might include their spouse. Who can own non-voting shares. It's often restricted to just family members of the physician. It'll say what kind of assets we can own. So you might be restricted from owning investments in your Prof Corp. You might not be allowed to have mutual funds or stocks or ETFs or whatever in your Prof Corp. Okay. It also says whether you can have a holdco. Okay, a lot of structures you're not allowed a holdco, and what types of business activities it can engage in. So a lot of Prof Corp rules say you can't. Yeah, so every time you have one of these bins, so let's say that you run into your first ever physician client. Okay, you with me here? And we'll do this together in a second. So you would go to the BC College of Physician and Surgeons website, and you'll actually find they do a pretty good job. Although maybe they do a terrible job, I don't know. But most of the colleges do a pretty good job of explaining this. Okay, we'll pop over and look at that together in a minute. Okay. Okay, so I've got my doctor here. So now you have a client who has done some harm. Well, what'll happen is they will sue both entities, okay? They're going to sue the physician, good, and they're going to sue the corporation. And there's no barrier here. There's no barrier at all for the physician in this case. Good. The Prof Corp is not a useful protector for liability. Are we 100% clear on that? Okay. Those of you who are incorporated, that's how your practice works too, isn't it? So I can't remember. I know Melanie's incorporated. Melanie, you have a personal license, right? You're licensed through FSRA yourself, and your corporation is licensed. That's right. And you and your corporation are both listed on your E&O insurance as insureds, right? And it's for exactly this reason, okay? Because the law does not intend that Melanie could use her corporation to shield her from liability if she ever harms a client. Okay. All good?
So what about a holdco for her?
So a holdco would give no more liability protection. She could set up a holdco and it could still be useful for separating active from passive assets, for one day potentially allowing her to sell the opco without having to sell the holdco. Could still have those uses, but it does not give her any more liability protection. And if she does get sued and she has a holdco that owns assets, her shares of the holdco are going to be used to settle that claim. So you're kind of right here, Todd, in that you wouldn't sue the holdco directly, but you would sue Melanie. And then if Melanie's other assets and insurance weren't enough to satisfy the harm done to clients, her shares of her holdco would go right into that pool as well. And then whatever assets the holdco owns would get sold, and those were used to satisfy the claims. That's good. So no more liability protection that way, Todd. It does not build a layer on top. Okay. Right. So this is a little bit of a different case here, Melanie. Let's look at a couple other lawsuits. Okay. Right. So that's what I want to show here. Lisa, your question and Melanie's question are opposite sides of the same coin. So let's say that we have a different source of liability. Okay. So we have a different source of liability here. And this is because the clinic manager harassed one of the staff. Everybody's with me there? That's what you're asking about, Alicia, right? In this case, the liability would stop at the Prof Corp. Okay. Now the doc is not personally liable. Okay. Is not medical malpractice. And the law says, well, whatever, that's a business issue. Okay. Yeah, it does. It's logical, Janelle, right? Now, what might happen is the harassed staff member might make an accusation that the physician also was a participant in the harassment, and then you got a different case, right? But if you're only suing for that type of harm, then the Prof Corp is really where the buck stops. That would be the same if you had a slip and fall on an icy sidewalk or something like that. Okay. That's all good? Okay. And to your comment, Melanie, yeah. So what if the physician, what was your thing you did? Oh, the car crash. So yeah, if the physician is driving and causes a crash and somebody is harmed, excuse me, sorry. there's no protection from the corporation here. There's no protection. What's going to happen is you would have a lawsuit against the physician, and the shares of the Prof Corp could be included in that settlement. Okay, good. Okay, yeah, ideally you have proper liability insurance here, okay? So often though, Stephen, it's outside of your control, right? This is a real thing that happens. So if you have somebody who has that slip and fall and hurts themselves badly, then, well, okay, so then you may find that you have your own insurer steps in and pays benefit. This happens more with car crashes. I shouldn't use slip and fall, but you could have this with a slip and fall as well. Your own insurer pays you a benefit, and then they say, well, now we're going to sue the other insurer, right? Right. But your shares of the corp are an asset, Melanie, right? So the physician's shares are an asset, just like their shares of Royal Bank or their shares of Power Corp or whatever, right? So, I mean, in theory, somebody could sue the physician, take the shares of the Prof Corp, and start running that business themselves. That would be weird, but it could happen, right? I'm sure there's some story out there somewhere about somebody who won a bar in a lawsuit and is now running that bar. Okay. Yeah, that's right, Nicole. So that would be true, Nicole, whether we're talking about the shares of your holdco or your opco, right? Okay. All right. That's all good. Yeah, that's tough, eh? This is actually one of the reasons. In fact, this is a funny coincidence, Bonnie. I advise financial advisors to never settle for their minimum liability. Okay. Financial advisors are good targets for lawsuits, especially as you get more and more successful. We talked about this back in chapter 12 as well. And I believe financial advisors should have the maximum personal liability insurance they can carry. So however you do it, you get your auto insurance liability up to 2 million, or whether you take an umbrella liability policy on top of your auto and home, right? But I think it's something that everybody on this call should be talking to their own insurance, their property and casualty insurance professional about, is tacking a little bit extra onto their personal liability insurance. And ditto for your errors and omissions insurance. Do not take the minimum amount of errors and omissions insurance. If you never do business with anybody at more than 2 million, then a 2 million E&O policy is fine. But if you occasionally sell a $3 or $4 or $5 million whole life insurance policy, you should have a $3 or $4 or $5 million E&O coverage. Okay. Yeah, that's one thing that creates substantial liability risk, Bonnie. Yeah. Okay. Good. So yes, a friend of mine emailed me this morning, said, hey, I finally got around to buying that umbrella liability insurance you're always harassing me about. It's like $54 a year for an extra $1 million of liability coverage. Okay. Okay. Yeah, that's good comparison, Bonnie. All right. Any questions there? Perfect. Okay, let's just pop over to, I think this will work. There we go. All right. Everything's weird on my computer now, so bear with me here. College of Physicians, I guess, not the college. Oh, there's College of Physicians and Surgeons. Okay. So this is how I would do this if I ever, and I do get this question. So when I have this question, I'm going to look at standards and guidelines for physicians. This actually looks familiar. Okay, I might have been here before. And you see that there's a specific section here, Ben, for medical corporations. You with me here? So I just click on the medical corporations section, and then I would see probably the FAQs are going to answer a bunch of this stuff. I'm not generally a huge fan of cracking open the Health Professions Act, but sometimes you have to. Okay, so I would look at the FAQs here, and usually these are well done. No, they will not. We know that. So you have to have PC typically in your name. Have to use a lawyer here. I think that was your question before, Shade, right? Where am I looking here? This is really what I want to know down here. This is typically what you're going to care about. Yeah, not particularly useful, actually. So you might have to go and read the stupid Health Professions Act, okay? And the Health Professions Act is going to give you whatever rules you need. And I want to go to the physician section. There we go, health profession corporations. And you're going to have here, this is a nightmare, honestly. So no corporation other than a health profession corporation may carry on the business of, yeah, that makes sense. Here, the services must be provided by a registrant of the college or an employee. Here, okay, so this would be an example, Ben, of a relevant clause. All voting shares of the corporation are legally and beneficial owned by, you can see this, registrants of the college or another corporation. So you could have a holding company in British Columbia, if I'm reading this properly, and don't take me at face value on a 30-second read of legislation. That's good. I need to actually read the legislation, okay? And it looks like, yeah, you can have then your spouse and so forth, all as shareholders. That's the kind of thing you would look for. I would have expected to see that in those FAQs, but whatever. And then further, you might get a restriction somewhere in here. Yeah, no, it doesn't look like there's any restriction on investment activity or anything like that. Pretty generous in BC. I would want to read this carefully. But honestly, Ben, what's really going to happen here is if you ever have a physician client who brings you this kind of question, you would go and sit down with a lawyer, and the lawyer would navigate this with you and make sure that we understand all the prohibitions, because that person has to use a lawyer to incorporate anyways, right? But you can get a rough idea here. Okay, good. I don't like the lack of commentary in the FAQs. I find that's a little bit iffy, but whatever. Okay. Questions there? All right, so we're going to change topics again here, and now we're going to move on and talk about the, I do know the control F trick, Melanie. I wasn't 100% sure if I would find anything or too much if I control F for Prof Corps. Okay. Yeah. And it didn't take me too long to find what I was looking for that way, right? I have read enough Medical Professions Act or Health Professions Act or whatever to at least have a rough idea what I was getting myself into. Yeah. Yeah, I do use Control F all the time, Melanie. So, yeah. So good. But there, I knew what I was looking for. I didn't really need help. All right. Good. Yeah. I'm a big fan of that. So I use 2 monitors, Melanie. I'm always 2 monitors, but yes, when I don't have my second monitor, the split window is genius. Yeah. Okay. So okay. Even when I travel, not that I'm traveling any right now, but I always carry a USB cable with me. Anybody do this? I always carry a USB cable with me, and then I use the hotel TV as a second monitor. Anybody with me there? You can't always. Some TVs, the USB is hidden somewhere, but yeah, that's my travel trick. Okay. Oh, sure. Yeah, that makes sense. So yeah, that way you can Netflix onto your hotel TV, right? Okay. So, all right. Now we're going to talk about selling a business, and we're going to look at this very broadly. And I know we haven't done lifetime capital gains exemption yet. We will. Okay, we're only a few minutes away from the lifetime capital gains exemption. So I've got a corporation here. Okay, and I've got my shareholder. And we're going to sell the business. Now, what's this business worth? When we're selling a business, what's it worth? We had this question last time, right? There's only one answer to this question. That's it, okay? So we can do a valuation like that, but really the only thing that would determine the value of the business is a negotiated price. So what somebody's willing to pay. Okay, so I have a buyer over here. We have a negotiation back and forth. And based on that, we determine what somebody's willing to pay. That's right. Okay. Now there are some different starting points for the valuation of a business. So if you have some businesses are going to sell for, yeah. So in a fire sale situation, Stephen, that's where you would often see a business sell for its book value. Okay, so book value is one potential way we can value a business. Yeah, I'll talk about that in a second, Esther. So book value is simply the value of the assets minus the value of the liabilities. Okay, it's not that common to see a business sell for its book value. This is typically done in Stephen's fire sale situation. That is where somebody's desperate to sell. It's sometimes done in equipment intensive businesses. Okay, we sometimes see it there. And similar to the fire sale, we also see this done sometimes as a liquidation. So our business owner has died, and now we just have to get rid of everything, and we're going to do it on a liquidation, or somebody's declared bankruptcy, and we just have to liquidate assets. So that's not that common. Nobody wants to do a book value sale. Okay, what would be far more common is some sort of earnings-based valuation. Okay, and in earnings-based valuations, yeah, we're going to do something like this, exactly that. Todd, we're going to look at some number. Now, this might be revenue, and that's sort of your unicorn feature. You don't see a lot of businesses sell for a revenue multiple. What we normally see is businesses sold for EBITDA multiples. EBITDA is your earnings before interest, taxes, depreciation, and amortization. Yes, it absolutely does. Yeah. It absolutely depends what kind of business. That's your most common multiplier. And sometimes we'll sell for income. So a multiple of your net income. Okay. And sometimes we'll sell for what's called SDE. SDE is your salary and discretionary earnings. Okay. So you'll typically only see revenue multiples in, see this in software and high tech a little bit. This is where you're really selling for your ability just to generate cash flow. EBITDA, this is the most common in small business. Okay. You'll find even in big business, a lot of big businesses still sell for a multiple of EBITDA. And again, Todd is right here. It would be quite typical to see a valuation somewhere 3 to 5 times. It's typical. You sometimes see higher multiples. Okay. You can certainly go higher or lower. Okay. Net income. So this is not that common. You'll find that this happens in specific industries. I believe you'll find dentists and pharmacists often sell for net income. Okay, and SDE, this is most common in lifestyle businesses. Okay. And what this is, it's basically a sum of how much value the old owner got out of owning the business in any given year. So this is where we add all your value for owning the business. So for example, if one of the things the business did was send you to a convention in Hawaii, you and your spouse got to go to a convention in Hawaii, and kind of a questionable convention, you go for like a week, you're only there for 2 days, you would typically add the value of paying for that convention into your SDE. Good? And then we often normalize these things. So these are typically normalized, which means that we take out any kind of oddities that might not show up for the buyer. So if you were paying yourself a very high salary, we would assume you were paying a more normal salary and adjust EBITDA on that basis. Okay. Now, once we compare your earnings-based valuations to what somebody will pay, or your valuation to what somebody will pay. Okay, so I look at the valuation versus what the buyer will pay. Okay, sometimes you end up with an accounting problem. Sometimes, so basically what has to happen here is your accountant has to be able to track everything that you bought. Okay, everybody's with me here? So the accountant has to be able to sort of put a value on whatever you bought. And what happens then is if what you paid was greater than the value, than the, let's say the accounting value of the assets, then your accountant will use a little gimmick here to make this wash out. That's where we use goodwill. Okay. So if you ever look at somebody's financial statements and you see goodwill on them, you know what it means. You know it means that at some point in the past, that person has acquired somebody else's business. That's the only way you'll ever see goodwill reported. That's good. Okay. Now, in non-accounting language, we typically refer to goodwill as the intangible value of a business, the stuff that we can't put our finger on, but we know it brings value. So it's close to the accounting language. Yeah, so Janelle, we're going to talk about buy sells fairly extensively in chapter 6, but it is normal in a buy sell agreement that you've set the price in advance. So you don't have to worry about figuring out the price, although some buy sells will set a formula. So you could actually, have a buy sell that says we're going to sell for 3 times EBITDA or the sum of the last 3 years EBITDA or something like that. You could do that, but it's normal to set a fixed price. Okay. And in that case, you're right. You may end up having, now, typically you're buying shares and not assets, so you don't have to worry about goodwill there in a buy sell. But if you were buying assets, yeah, you might see some goodwill. Okay. Now that I'm thinking about it, I don't know if I've ever seen where a buy sell actually had a goodwill element to it. That wouldn't be typical, because you've got 2 people who both know or maybe more than 2, who both know the business relatively well. Neither of them is going to, quote unquote, overpay for it. Okay, they're going to set a price that they know they can manage, and especially because they're often insuring that risk, they typically don't want to have an exorbitantly high value there. Okay. Good. I guess I can throw one more comment in here. So once we arrive at this value, we often move to the enterprise value. Okay, so enterprise value is essentially the value of the business minus any debts. Okay, and this is where it starts to get a little more complicated, because what actually constitutes the debt of the business is not always clear. This is where you get into questions around shareholder loans. If you happen to have a shareholder loan, how do we address that? Okay, questions? All right. Okay, yeah, it's a good question with the goodwill thing. It's always nice when that comes up, Esther. All right. Now, I just want to give a quick review here, a recapture of depreciation. Hoping we can avoid getting into a whole quagmire here with recapture depreciation. Okay, so let's say, for the sake of argument, that my business bought a piece of equipment, and in this case, what are we going to have here? Let's have a front end loader. Okay, there, pretty close, Stephen. All right, so front end loader, and we paid $2.5 million for it. I've never bought a front end loader. I assume $2.5 million is a possible price you can pay for one. And what happens then is you can't deduct that cost, right? You can't deduct the $2.5 million. Okay, instead, you would depreciate that asset, I believe, at a rate of 8%. I think that's right for a front end loader. Okay. So now you've owned the asset for several years. And at this point, you have taken, let's say, $400,000 of depreciation. So now my ACB for the tractor is still the same, right? Or for the front end loader, my ACB is still $2.5 million. Okay. My fair market value is maybe, let's call it $1.9 million. I don't know what depreciation actually looks like on front end loaders. My UCC is $2.1 million, right? That's the ACB less $400,000 of depreciation. What happens now if I sell? Oh, I'm going to flip those around actually, sorry. I'm going to give this thing a fair market value of $2,200,000. Okay, that's better. All right. What happens if I sell my tractor for $2.2 million? Or sell my front end loader. Stephen, you got me on a tractor now. So what if I sell for $2.2 million? What's going to happen here? We're going to have, it's going to be recapture, right? Remember, there's going to be recapture of depreciation. It's a depreciable asset. And we're selling for less than ACB. So we're going to have fair market value minus UCC gives me my recapture. So we're going to have $100,000 of recapture of depreciation. Okay. And how is that recapture of depreciation going to be taxed? So it's regular income. That's true. Okay, taxed as income. However, it's actually not necessarily that bad in your corporation. You're selling an active asset. I'm assuming that a front-end loader was something I was using in my corporation. If I'm selling an active asset, then it's taxed as active income. Okay, so I would really only pay tax at roughly 12% or maybe 27% on that disposition. So as much as it's unfortunate that it's not a capital gain where you get capital gains inclusion and all that, at least you have a low tax rate on the associated income. Is everybody with me there? Yeah, it's not the worst thing, Todd, right? Okay. Perfect. Are we all good with recapture then? Does that make sense? So it would be very normal in an asset intensive business like road construction or a printing press, anything like that. It would be very normal in asset intensive businesses to have, yeah, exactly, a paving company, to have tons of potential recapture as you sell your assets. Okay. So the depreciation got me a tax deduction, right? So as I claimed that depreciation, Stephen, I was able to reduce my taxable income by $400,000, right, over those many years. You with me there? Yeah, trucking is another great example, Sherry. And then when it comes time to dispose of the asset, that's where I can have that sort of reverse consequence of being able to deduct all that. Okay. Exactly that, Stephen. Yeah. And quite correct, Janelle. Let's have a look at that on the next slide. All right. Any questions before we move on here? That's kind of what happened, Stephen. Yeah. The Income Tax Act allowed you to deduct $400,000. Turns out should have only taken $300,000. Now we're going to undo 100,000 of that benefit. Okay, perfect. Well, I guess it's CRA. I mean, it's as much as CRA does everything else with your taxes, it's part of the normal income tax process. Okay. So this is what Janelle was just talking about. So when you are selling a business, there are two significantly different ways that we can sell that business. So we can have either an asset sale or a share sale. Okay, so let's say that I am selling a business. My business has a value of, let's say, $2.5 million. So we sat down with the buyer, we've negotiated a price, we've come to $2.5 million. So one way we could look at this, we say, all right, what are the assets of the business? So the assets are worth $2.5 million. Okay, that's the fair market value, but let's give them a $3.1 million UCC. Okay, so here's what could happen. If the buyer buys these assets, they're going to buy them from the corporation. Okay, and what'll happen then is the corporation, oh, sorry, I apologize, I messed that up. Why do I keep doing that? There, 2.1 of UCC. Good, I made it up, Esther. I completely made it up. And what's more is I was wrong, okay? So, okay, but that would be fairly typical, okay? So the corporation will take in $2.5 million. That's right. And then has a $400,000 recapture of depreciation. Okay. And now the seller is left with a corporation that has no assets. We agree with that. The buyer bought all the assets. But we have a bunch of cash, right? We're going to have around, so net of tax, we're going to have somewhere around $2.4 million in the corporation. Okay. Would everybody agree with that?
Explain with that why it's 2.4.
I knocked off $100,000 for taxes on the recapture.
Okay.
That might not be quite perfect, but let's say $100,000 of tax paid on recapture. It'll depend what tax rates you're at and so forth. So we're going to be left with about 2.4 million. Okay. So what has to happen for my shareholder now to get that 2.4 million out of the corporation? What would have to happen here? How's that money paid to the shareholder? Has to be dividends, right? Okay, and if you take that much dividend out, well, was there a capital gain here, Esther? Did we have a capital gain? No capital gain. Then is there a CDA credit? No CDA credit, right? So this person has to take taxable dividends out. You're going to lose somewhere, call it 40% to tax, depending on how much of a rush you're in to take it out. If you can spread that out over a number of years, of course, you're going to minimize that tax burden, but that's a fairly expensive proposition anyways, isn't it? Okay. Well, what would a holdco do here, Esther? What would be the benefit of a holdco? Sorry, what cash would I have though? So you're assuming that I stored cash in my holdco, but that doesn't change any of this. Even if I had a holdco, I still just have another corporation that has cash in it, and I also have to take that cash out now on a taxable basis, right? There's nothing about a holdco that changes any of what you see right here. This would be the same with or without a holdco. Okay, good. I can put a holdco in here if you want to see one, Esther, but I'm not going to change anything. Okay. And arguably, Esther, what's happened here is what used to be a my opco is really now a holdco, right? It doesn't own any active assets. It just owns passive assets, just has cash. Maybe you use that cash to invest. I really am left with a holdco. Okay. And you're going to see this kind of thing depending on who you read or whatever. But if you're going to leave that $2.4 million in the corporation and use that over several years, we might call this now a holdco. We might call this an investco, a retireco, whatever. It's all the same thing. I'm really using my corporation kind of like using an RRSP, right? Just now invest, pull money out, invest, pull money out. Or I might strip the whole $2.4 million out over a very short amount of time. I pay more tax, but maybe my life is simpler. Okay, that's all good. All right, then we could have a share sale. So now my share sale, once again, we have assets of the business. We got $2.5 million fair market value. And we've got $2.1 million of UCC. That's weird. Okay. And now I've got my shareholder. And let's say for the sake of argument, my shareholder has a nil ACB, which is by far the most common thing, or a nominal ACB, if you like. And now sells the shares for $2.5 million. Okay. Everybody's with me here? So this is going to be a little bit different. Now we're going to have a capital gain right away here. So proceeds of disposition of $2.5 million. I have an ACB of 0. That gives me a capital gain of $2.5 million. And then I'll apply my inclusion rate of 50%. And then I have my taxable capital gain is 1.25 million. And then let's assume a tax rate of 50%. So if I've got 50% tax here, I'm now paying $625,000 of tax. So net of tax, you're now left with $1,875,000. The difference here, yes, I have less money than I would have had if I had incorporate, or if I'd sold the assets, but the money is all held personally now, it's all tax paid dollars. I don't have to take that out as a dividend or anything like that. That 1.7 or $1.875 million is all tax paid money. Would everybody agree with that? And in addition to that, and we're going to see this a little bit later on, you may also be able to use the, yeah, that's it, Stephen, right? You may be able to use the lifetime capital gains exemption to reduce that hit by about $220,000. Okay. It's not the same as share redemption, Bonnie. That's quite a bit of a more complicated thing. We're going to see that a little later on. This is just straight up selling your shares. So somebody came to you, said, I want to buy your business, Bonnie, and you just said, fine, I will sell you my shares. Okay, the shares still exist. They just moved to a different shareholder. Okay. Which of these would you prefer to do as the seller?
Sell the shares.
Right, because you've got so much more tax paid money that way. You might use your lifetime capital gains exemption. You don't have to kind of tax plan selling the assets or sorry, getting that $2.4 million out of the corporation, knowing you're going to lose a bunch of that to tax.
So Jason, when you sell the shares like that, is the guy giving you 2.5 million, or can he do it as like a loan of 2.5 million?
So we'll look later on at the capital gains reserve. It is possible that the buyer pays you over 5, or if it's a family member, 10 years, and we can get some tax efficiency there. Now, there's also the question of whether you would want to take that money over that 5 or 10 years. And yeah, it's also very common that there's deferred compensation in either type of deal. It'd be very normal to see something paid over 2 or 3 years instead of all paid in one lump sum. Okay, so generally speaking, the seller usually prefers a share sale. Okay, and the reason for that so the kid bought out their parents, Stephen, and they bought them out all on a deferred basis. Yeah, perfect. Okay. We're going to see something like that in chapter 6 of Advanced, Stephen. Yeah. So the seller usually prefers a share sale. The lifetime capital gains exemption may be available, and you'll have after-tax dollars at the end. Okay. The buyer, on the other hand, will generally prefer, now this is not universally true, and I will give some qualifying statements in a moment here, but the buyer generally prefers an asset sale. And the reason for it is because the seller pays all the recapture depreciation. I'm not buying assets that are going to have a recapture on them when I sell them right away. I'm going to really have the buyer take care of all that tax liability. And the other thing that happens here is the seller retains all the legal liability. Okay, so same deal as my medical clinic. If it turns out that we have a manager in the business who harassed an employee, that's the shareholder who sold me the business. That's their problem. I didn't buy that problem. Okay, everybody with me there? So what happens when I make an asset purchase? I'm not buying any of your past. I'm not buying any of your headaches or your baggage or whatever. I'm buying and starting fresh from both a tax and legal liability perspective. Does everybody see that? Todd's with me here. Melanie's with me. Now, that being said, thanks, Betty, Sherry, perfect. That being said, you will sometimes find buyers who are happy to do a share sale, or maybe not even prefer it, but be willing to do it, okay? The first thing that happens is sometimes the seller will give a discounted price. So the seller might say, well, when I take into account taxes, I'm willing to carve $200,000 out of that price. Right, because you see that, Stephen, if I buy the corporation, so if I buy the shares of the corporation, and there's a manager in there who 6 months ago harassed an employee, and that employee hasn't done anything about it yet, but one day they're going to, who is the employee going to sue because of that? So they might sue the manager. They're going to sue the corporation. Okay, so you're buying that liability, Steve. You see that? So I think, Sherry, this is important anytime you're dealing with small business owner clients, and that would include farmers and fishers and the like. Okay, really anybody who has any possibility of selling their business or transferring it to kids one day. Okay. All right. So the seller might be willing to give a discounted price here to do a share sale. Now, when else do we see this? So we also see that when a senior is selling to a junior, okay, and that sounds very much of the case you just described, Stephen, that would be very normal, where the senior is basically, come on, financing the deal, okay? They say, look, I'd much rather sell you shares. If you're gonna buy me out, you're gonna buy me out under my terms. Okay? And then the third one we see, which is not that common, but I've seen enough of this now to not dismiss it, is if we have a very large company, often a publicly traded company, okay, or maybe private equity backed, okay, that type of thing, okay, if we get this, then we're going to have lots of due diligence. And we're going to have what are called reps and warranties. So representations and warranties, which is where the seller says, if anything goes wrong, then you're going to be able to recover those losses financially from me. So we have just a boatload of due diligence here, plus these reps and warranties. Okay. And now, basically the seller has taken other steps to reduce their, sorry, the buyer, I apologize, has taken other steps to reduce their risk. They know everything about your business by the time they buy it. They know what all the liabilities are. And if there is anything that was missed, then they can also come back to you and take that away financially later on. Yeah, it's a great example, Bev, right? When you buy somebody else's book of insurance business, it'd be very common to include a clause in the sales agreement that says you have to maintain E&O insurance for maybe 5 years, 10 years, maybe for life, right? And there is a special kind of E&O insurance that you can buy for people who have sold their block of business. are no longer active and are just keeping that E&O insurance to meet a condition in a purchase agreement. Okay, that's good. That's normal in this business, Bev. That would not be normal if you're selling a dry cleaning business. Okay, that's good. Okay. In fact, my original business coach, Bev, my very first business coach, who I'd love to go back to, actually, was so good, but I don't know what happened. But anyways, he had founded a business that he ended up selling to, and I can't remember how it works exactly. I apologize, but he sold it to a company that got acquired by NBC right after he sold it. So he sold his business, and then the company that bought his business got acquired by NBC. Good. And NBC came back to him on the reps and warranties. He had sold for 22 million, and NBC came back on the reps and warranties, and they tried to get that price knocked down by about $10 million. And so they ended up in court for a few years over this, right? And it's one of these things that eventually everybody just has pain, right? There's no E&O insurance for that kind of thing. Okay. All good? Perfect. Okay. Now we'll get into one of these topics. This is one, Stephen, that sometimes people are here just for, is the lifetime capital gains exemption. Okay, so lifetime capital gains exemption is quite an attractive section of the Income Tax Act. We'll see if we still have it a year from now. But as of today, what happens with the lifetime capital gains exemption, if I have an individual, okay, it has to be an individual, that's a flesh and blood person, okay? Yeah, I think that's an even money bet, Stephen. Good. So I have an individual selling any of three types of property. The first being shares of a qualified small business corporation. Okay, QSBC. The second being qualified farm property. And the third being qualified fishing property. And we normally abbreviate both of these as QFP. So you'll see QFP, could be QFFP. I see that done sometimes. More often than not, I see it just as QFP, which really captures both farm and fishing. Okay, so is everybody clear with me, for starters, that I have to be selling one of these three types of things, and it has to be an individual, a flesh and blood person selling these things? Good? Okay, so if we're selling shares of a qualified small business corporation, QSBC, then you can exempt up to $883,334 of capital gains. Now, do not memorize that, okay? Do not memorize. What you really should know here is that it's around 800,000. Somebody said that earlier. I can't remember who made that comment earlier, but one of you made the comment that it's around 800,000. Actually closer to 900,000 today, but whatever. We're in the ballpark. That's good. That 883,000 figure is indexed to inflation. So next year it might be a touch higher. Okay, up to a maximum of $1 million. So as of today, this would index up to 1 million. When it hits 1 million, it'll cap there. Okay, so I thought, Stephen, but I couldn't remember for sure. Okay, that's the proper shorthand for 1 million, Melanie. So if you're doing like accounting shorthand, this is 1,000, and this is 1 million. Okay, good. All right, you're right, because I've done that forever, Melanie, right? Yeah, which it's really from the French, right? Like mil. You with me there? Yeah, okay. I think it actually might be Latin originally, sorry. It's up to 883, 334, Esther, today. And then it's indexed. You with me? So the word you're missing there is indexed. It's indexed from the 883, 334. So it'll be a little larger next year. So it might be, I don't know, 890 or 895 next year. Okay. Honestly, I think it'll be 883, 334. I think we're going to see inflation is nil, but whatever. Might go up a tiny little bump and then a tiny little bump the year after and keep going like that until it hits 1 million. Yeah, exactly. Okay. So you must be selling shares of a business or, sorry, you must be selling shares of a business where you or your spouse own the shares or the underlying assets for 24 months prior. Okay. So that means you could have been unincorporated. You may have been running your business as an unincorporated business. And now you turn around today and sell your business. That's good. Your buyer says, I'll buy shares if you want. So you incorporate and sell that day. You could use lifetime capital gains exemption there. And it's not a hard thing to do, to incorporate and sell sort of immediately all at one time. The business must be primarily active. Okay, now there's two different tests here. These tests are actually quite complicated, but the rules, the basic rules are not that bad. So what has to happen? There has to be 90% active assets at the time of sale and 50% active assets, okay? I'll do this, 90% or more and 50% or more active assets for the prior 24 months. So you can't be selling a business that's been primarily passive. The business has to have been primarily active, okay? Has to primarily do business in Canada. Okay, now that can include a Canadian-based business that does global business as long as it's really headquartered and operated in Canada. Okay. And the seller must have, and I'm going to use this word, it's a terrible word, but it's the right word, and unfortunately there's not really a great other word for it. The seller must have indefeasible rights to the shares being sold. So I think you're asking more about a farm question, Bev. Is that fair? Let's deal with that when we talk about farming down below, okay? Okay, so the seller must have indefeasible rights to the shares being sold. What that indefeasible or sorry, I should say indefeasible, not undefeasible, okay? What indefeasible means is that you're not required to sell the shares to anybody. You're selling them because you want to sell them to whomever you're selling them to. Okay. It's kind of like undefeatable. Your rights are undefeatable by any other clause or condition. Okay. It's a terrible word, Melanie. I wish that we could have some other word here. Unfortunately, that's the word, and it does have some relevance to some later stuff we're going to see. All right. Okay, so then my qualified farm property or qualified fishing property. Okay. I may have avoided using it in the text, Todd, and if I did, I'm happy. Okay, I don't mind that. All right. So did you do a Control F, Todd? Is that what happened there? Okay. This is the time for Control F. So when we look at qualified farm or fishing property, here, this could be shares of a farm or fishing corporation. Okay. This could be an unincorporated farming or fishing business. So sole proprietorship or partnership. Okay. It could be a trust. It could be a family farming trust or family fishing trust. That owns the right assets. Okay. So it really can be any number of structures. It's not typical to have, for example, your farm. In family farms, you'll typically see some of it is incorporated and some of it's not. I think, Bev, didn't you ask that question last time we're together? Somebody on the call asked that question last time we're together about the farm and why some is incorporated and why it's not. Okay, so what constitutes farming property? We have quite a broad definition. Okay, well, there you go, Bev. All right, look at that. So somebody asked that question on Tuesday. So anyways, the farming property is going to include your arable land. It will include machinery and equipment that's used in farming, buildings, and what's often, other than land, the most valuable thing you have here are your rights and quotas. Okay. Now there's a bunch of other miscellaneous stuff that is considered farming property. If you have a beekeeping operation, beekeeping is generally farming property. Okay. Trees grown under a registered forestry management plan, generally considered farming property. Okay. We have a whole list of stuff that is farming property, and it really is anything that somebody who sort of lives on a farm and makes their living with would count as farming. Good. And then fishing property. So this could include a kind of land. We include aquaculture operations here. Actually, aquaculture can also be farming, but primarily what we're looking at here is the boat, which is not going to have a capital gain. It's generally not a big deal, right? Boats, the corporation itself, but the big thing you're looking at here typically is your rights, again, your rights and quotas. So the ability to actually produce, that's where you typically get the real value in a fishing business. I know he's gone this afternoon, Melanie, and here we are with all this fishing stuff. All right, good. Nice. Okay. It has been a quiet afternoon. That's kind of true, isn't it? You and Andrew and Todd all usually have questions that you'll verbalize for us, and we haven't had much of that. All right. Yeah, somehow, I don't know. Okay. Well, I think there's some overlap there. All right. It's nice, isn't it, Nicole? You can just roll into the weekend now and think about lifetime capital gains exemption all weekend. Okay. Okay. Now, whatever the property is, it must be actively farmed or fished. Okay. And not a big deal with fishing businesses typically. It's not that common to run into the passive question around fishing businesses. Okay. I know, but now I have another class on Thursdays. So they've taken your day away. So so the actively farmed or fished question, where we get problems here is if we've leased land or any sort of crop sharing arrangement. Okay. Now, I'm going to say that those are problems. I'm not necessarily going to say that those would prevent you from using lifetime capital gains exemption. But if you have somebody, and who asked the 25-year question? Bev, was that you? Is that Nicole? I can't remember now. If you've been, yeah. So if you've been leasing that land for the last 25 years, you may be offside now. You may not be able to use the lifetime capital gains exemption. Okay. That's good. However, there are all kinds of fine little rules here. For example, if the farm has been in the same family and has only had lineal ascendancy, okay, that it's only gone from parent to child to their child to their child, and it's been owned in the same family since prior to 1987. I can't remember the date. I want to say July 12th. Anyways, July of 1987. And at some point in that history, it was actively farmed for at least 2 years. Then you generally can still be leasing it today and sell it and use lifetime capital gains exemption. Okay, that's good. So what really has to happen here, Bev, is you have to find an accountant who knows their tax rules very well, somebody who stays current, and tie up with that person. Okay, I see a lot of bad stuff done here with farming. I see a lot of carelessness. I see a lot of sort of telling clients what they want to hear. And there's nothing but trouble when that stuff happens. Okay. Okay. Yeah, perfect, right? Having that ag tax specialist. Okay, I knew what you meant. All right. That ag tax specialist is golden. Okay. Somebody who does a lot of that work, and that person will know. They're going to know the rules in and out, Bev. And often, and I'm sure you've had this experience then, often they're going to have to do almost like a forensic type of situation with their clients. Okay. They're going to have a whole bunch of questions. They're going to dig into family history. They're going to look at every transaction that happened. And from there, you'll know whether it's active or passive. Okay, that's all good. Okay, the other problematic area here, and I know that Sherry and Bev have seen this kind of thing, is where we have oil and gas or mineral rights. Okay, generating income on the farm. That's passive. And if you have enough of that, that can render the farm as a passive asset. Okay. That's all good? Okay. Yeah, because you see that too, Nicole, right? Where you are, you see lots of fields that are crisscrossed by pipelines and have access roads on them for the pumping stations. And that farmer is making legitimate money just from the, although maybe not today, but yeah. That's it, Nicole, right? That land is now more like an oil producing asset than a crop producing asset, isn't it? Or natural gas, whatever the wells are. Okay. Questions? That is a type of farming, Bonnie. Yeah, the Income Tax Act doesn't necessarily agree with you, Bonnie. Okay. Yeah, and the unfortunate thing here, Todd, is it's a different lots to know for farming and fishing than it is for small business. Okay. All right. Yeah, I got it. And the rules have changed since then too, Todd. These rules have changed since then. Okay. On that note, there are some other things we have to know about the lifetime capital gains exemption. Okay. So up until 1994, we had a $100,000 exemption, and that $100,000 exemption could be used against any property. You didn't just have to use it for QSBC. So then from 1995 on, we had a $500,000 exemption, and this was QSBC only. And then in 2006, this is where we changed it to a $750,000 exemption. And now we have QSBC and farming.
Jason, can I ask you a quick question?
Yeah, absolutely, Melanie.
I was just reviewing my notes from the previous slide, and it says indicate the three types of property. So shares of a qualified small business corp, so shares. And
Yep.
then one of the sub points was must be selling shares or assets. So is it shares or is it shares and or assets?
It's not that you must be selling, it's that you must have owned the shares or the underlying asset for 24
Oh, okay.
months. Okay.
Okay, but
So,
it is for the purpose of selling shares only, right?
yes, that's exactly right. So where that shows up, Melanie, is if you're not currently incorporated,
Mhm.
and somebody brings you an offer, they say,
Right.
Melanie, I'd be happy to buy your business. You could incorporate today.
Mhm.
You've owned the underlying assets for 24 months.
Mhm.
Good. You
Yeah.
sell tomorrow and you could use the lifetime capital gains exemption.
Okay, got it. Thank you.
Yeah, so you've owned the shares for a day, but the assets for years, right?
Okay, thanks.
So then in 2016, we went to an $800,000 exemption, indexed, and of course, $1 million. Oh, I didn't mention that on the last slide, sorry. It's $1 million exemption for farming and fishing and not indexed. Okay, so it's already at its maximum. Good. And that's how we're at this 883. So what has to happen here when you sell? So let's say, well, I think we're not going to see that, Bev. It's only 2016 since it was changed. I know a lot of farmers have much larger gains than that. Farmers already have some pretty good other advantages like roll over to the next generation, right? So what happens here, let's say I used the $100,000 exemption, and this was very common, okay? Well, that's true. All right, Bev, yeah. But if I used the $100,000 exemption, I used it, whatever, for my cottage in 1994, okay? And I'm selling my business today. Okay, and actually, Melanie, where you are, you would see a lot of people who did this exact thing, okay? There'd be tons of people in the Ottawa Valley who in 1994, when the rule changed, because what happened when the rule changed was you could trigger your capital gains exemption without actually selling the property. Okay. And Stephen, same for you. You'd have a bunch of people in the Muskokas who triggered this capital gain, increased their ACB, and have now used some of their capital gains exemption. That's good. So now I'm selling my business today. I'm planning to use the capital gains exemption, okay? But I've already used $100,000 of it, okay? So I only have now $783,334 available, okay? That's good. Now, as it grows, you also have that increased access to it. So let's say, similarly, I have somebody who sells a business today, okay, and uses all $883,334. And then let's say 2 years later, sells a farm. So they would have $1 million minus 334, sorry. They have $116,664 of exemption available. Okay, is everybody with me there?
How do you get that math?
Oh, sorry. I make a mistake mostly. I put a
No,
one.
I'm just confused.
There. Is that better?
Yeah.
Okay. All right. Yeah, it's now, yeah, 883, 334 for QSBC and $1 million for everything else, Rosalind. Yeah.
So the 116 would be taxed, right?
No, they still have that much exemption available.
Oh,
they
up
could-
to the million. Yes.
Yeah, up to
Okay.
the million. Yeah. Okay. So if you need the exact dates, Bev, you'll be given them. What's more important here is that you recognize that a prior use of the exemption is something of a limitation on the ability to use it today. In my red scenario, Bonnie? I have it right there. They sell a business today that chips away at some of their capital gains exemption. They sell a farm 2 years from now. They don't have much exemption left. Okay. So you don't get one exemption for farming, one exemption for fishing, and one exemption for QSBC. Okay.
I think we're confused just on the 883. That's how
Yeah.
much they can claim now.
Yeah.
And then you're saying they still have 116 because every year there's going to be indexing and then you can write off a little bit more in the following year or something, or
No, the farm is always $1 million. The farm is not an indexed figure. The farm is $1 million.
so that's only for small business. Okay, I got it.
The 883, 334 is for QSBC and the $1 million is for farm and fishing.
Okay.
Yeah. Okay, good. All right. Okay. Exactly. Those limits play against each other, Rosalind. That's right. Okay. Okay. So here's how this works, right? This is, I think the math is pretty simple. Yeah, exactly, Bonnie. That's all that would be left there is the 116,666, right? So you sell a business for, let's say, $3.4 million. You have an ACB of nil, which would be pretty common, right? Nominal ACB. Oh, I can't now, Alicia. Sorry, I apologize. Once I've done my new set of notes, I can't go back. Okay. Do you want to ask a question? The notes will be posted. You'll be okay. You'll get the notes. So if it's just a matter of taking a screenshot, it'll be there. Okay. Yeah, I can't get it back once I start the second set of notes here. Okay. So I have an ACB of 0. I'm going to have a capital gain here of 3,400,000. I'm going to apply my inclusion. Sorry, I apologize. I'm going to apply my lifetime capital gains exemption at 883,334. Okay. And now my net capital gain is going to be $2,516,666. And then I would apply the inclusion rate. Okay. And the inclusion rate at 50% is going to bring me down to my taxable capital gain. For $1,078,833. Oh, what's that, Esther? Okay. So, no, I'm still here. Did I mute? Okay, did you lose me? Can you hear me? My audio looks like it's working. Just bear with me for a second here. It shows strong, it shows valid. Just bear with me. I'm going to pause recording here. Okay, so thanks for letting me know. Okay, so we've got a taxable capital gain of $1,078,333. Which figure, Betty? How did I get which figure? I took 2 million. Oh, you know what? I made a mistake then. Yeah, you're right. That's, I don't know what happened there. All right, let's try that again. 2516. I must have typed something around my calculator. 666 times 0.5. That should be 1,258,000. Thank you. 333. Okay. All right. Okay. So apparently my microphone and my thumb both stopped working at the same time. Okay, so we've got that as our taxable capital gain. Everybody's with me so far? That's what you would actually pay tax on. Now, this is going to look a little different on the tax return. Okay, so on your tax return, here's what you would see. You have a $3.4 million capital gain. That's going to show up on Schedule 3. We're going to apply the 50% inclusion rate, and we're going to end up with a $1.7 million taxable capital gain. It's just how it goes, Bonnie. That's how the math is done. And in fact, I'm going to kind of show you the way it shows in the Income Tax Act here. This might help. Okay. So it's a capital gains exemption, right? It's an exemption against your capital gain. It's not an exemption against your taxable capital gain. Okay. So I've got a $1.7 million taxable capital gain. That's going to show up on line 12700 of my tax return. Okay. And then I'm going to take the capital gains inclusion rate, sorry, the exemption here, 883,334 times 50%. That gives me 441,667. Okay, that is what we call the capital gains deduction. It's the exemption with a 50% inclusion rate applicable to it. So what's going to happen here is we're now going to knock this down by that capital gains deduction, the 441,667. That's going to show up on line 25,400. Okay. Is everybody with me here? And I'm going to get the same thing. My taxable capital gain is now $1,258,333. Okay. Because on your tax return, Rosalind, you're not reporting 3.4 million, right? You're reporting the taxable capital gain on your tax return. Agreed? Okay, so it's really this on the right side in blue that shows what I would see on the tax return. Okay. Perfect. Okay, so then here's where we run into a problem. Okay. We're going to look at a concept, and we did see this back in chapter 9 very briefly, but we're going to look at something called alternative minimum tax. Okay, I don't know if anybody remembers this or not, AMT. And AMT is a tax calculation. All right, good stuff. Of course you remember it, right? Why would I speculate otherwise? So this is a tax calculation that applies to people who have high incomes and low tax payable in a year. Okay. Oh, I got it. Yes, it is silly. All right. That's true. That's probably the most important thing to remember about it. Okay. And the idea here is that we're capturing, okay, we're capturing your tax savings. We say good for you for saving a bunch of tax, but we have to now make sure that the tax you saved, you really spend in Canada. Okay. I knew that was going to happen, Todd. I knew that. All right. So here's what happens. Automatically, CRA does the AMT calculation, and so should your accountant. Okay, the accountant, their software does this. They just have to pay attention to the fact that it's happening. So the AMT calculation is going to take the amount of capital gain, which is $3.4 million. And this time you're going to apply an 80% inclusion rate to that capital gain. Okay, so we would take 3.4 million. $3.4 million times 80%. That's $2,720,000. That's what your AMT included capital gain is. And then from there, you would reduce that by that same capital gains deduction. The IRS has AMT as well, Esther. Yeah, the IRS has AMT as well. We can look at those scenarios, but yeah, really and truly, the Americans have AMT as well. So we take those two amounts. I don't think it's a problem of being smart. Okay, and we get to 2,278,000. $333, and then to that you would apply a $40,000 AMT AMT deduction. So now I'm at 2,238,333. And to that, I apply a 15% AMT tax rate. Okay. Now you're not going to have to do an AMT calculation. Never will you have to do an AMT calculation. I'm not showing you this so that you can do the calculation. I'm showing you this so that you can understand where AMT applies or does not. Okay, we're at the end, Nicole. All right. Well, we're at the end of the math anyways, okay? So you're, nice. That's funny, Melanie. All right, so you have a $337,750 AMT calculation. That's your federal calculation only. The provinces will add their own AMT calculation on top of that. Okay, and what I would do here, I know that I have a 1.258 million capital gain. Oh, I got an unstable internet connection. If I get kicked off, we'll start again right away here. Yeah, perfect. Oh, 335. Thanks, Todd. Yeah. Good call.
FYI, I can't hear you again.
Oh, what's going on here? All right, I did have an unstable internet connection for a minute there. Yeah, I would like to finish this concept and then take coffee, Bonnie. Okay. All right. Can you hear me at all now? I have no idea what's going on. No joy? Okay. Maybe, Todd. I don't know. We'll see what happens here. Do you have me again now? Are we good? Okay. I don't know what's going on here. Anyways, I take 1,258,333 times 33%. I'll get $415,000. That'd be my federal tax. So I'll have $415,250. That's my federal, we'll call this real tax. Okay. And what would happen in this case, unlike what I showed you back in chapter 9, okay, is I'm the only one on a computer at home today. And I don't think that's it at all, Todd. I think a whole bunch of stuff got messed with on my computer today. All right. So anyways, we compare these two amounts and the AMT is lower than the real tax. That's good. And because of that, there's no AMT to pay. Okay. But it is very normal in a lifetime capital gain scenario to have AMT payable. And it's something you should always be aware of is that possibility of AMT. Okay. For the farming folks, it is very common for a farmer who just does a freeze transaction, passes something on to their kids, that person gets dinged with AMT. No, it's one or the other, Carla. So they don't stack up. It's just one or the other. So if you had, let's say for the sake of argument, Carla, a $200,000 real tax calculation, you would pay $200,000 of real tax and $135,750 of AMT. Okay, so yeah, so they're not one plus the other. It's just the difference that you'd pay.
So it's just if it's lower, if it's higher, then you pay the higher amount.
Yeah, so in this case, you just pay the $415.
Yeah, okay.
Okay. Sorry, Melanie, go ahead.
Oh, am I off mute again? Whoops.
We both have gremlins. All right. And Todd, you want to ask your question right now?
Super quick, doesn't have anything to do with this. I have a client that I'm working on in a state, and this is the gentleman that passed away from he passed away from the coronavirus. So
Okay.
he had an insurance whole life policy with another company, and I never reviewed it with him because I didn't even know they had these from some other agent from way back when. It was supposed to be paid out to the beneficiary. Anyways, the check was made out to his mom, and the check being paid out to the estate, isn't that supposed to be probatable?
She said because she's the owner.
There you go.
That's
She just
why-
called back
She just
because
called
I
back.
told her she better call her lawyer, because if it's supposed to be paid out to the estate, she'd have to pay probate on it. You would think, because that's who was named on it, but they put
'Cause
his
she's
mom.
the owner. That's the reason.
Okay. Well, anyways, I was gonna ask you what you thought, Jason. So
If the estate really was the beneficiary, it should have been paid to the estate, but
well, that's the
That's the
case.
word
So
that
the question I have is that if it was paid out to his mom, she's the trustee and it has her name on it, could
She's the
they come
executor.
back? She's the executor. So could they come back on her and say, hey, you were supposed to probate this death benefit, and you
She's
never
gonna
did?
check with her lawyer anyways.
yeah,
Okay.
if it was Ontario, I'd be very concerned about that. In
was
BC, I would
BC.
be less concerned about that.
Yeah.
Okay,
She's gonna
thanks.
check, so, okay.
All right,
Appreciate it.
interesting though. Yeah.
Yeah, I know.
Okay. So I'm gonna shut down and reboot over lunch or over the coffee break here. So you're gonna have to rejoin again. Sorry, but I don't like what's going on with my audio, and I want to make sure everything is all tickety boo here. I've got 39 minutes past. We'll take a 15-minute break. We'll resume at 6 minutes to. Okay, we'll see you back then. Thanks.